Are we living in another dot-com bubble, but this time with AI? In the next few minutes, I'm going to show you exactly why the market could be heading for a major correction of over 20%, which stocks are the most dangerous, and where the real opportunities are hidden right now. Michael Burry, the man who predicted the 2008 crash, is betting millions against stocks like Nvidia and PLTR. So what is he seeing that most investors are missing? Let's break it down. First, what is a financial bubble? Simply put, it's when the price of an asset, like a stock, inflates far beyond its real value. This isn't driven by logic, it's driven by exaggerated hopes and, most importantly, by FOMO, the fear of missing out. Everyone sees their neighbor getting rich on a hot stock, so they jump in, pushing the price even higher. It becomes a chain reaction. This usually happens when the economy seems strong and everyone is confident. But bubbles are unsustainable. They always burst. And when they do, the fall is fast and brutal. Right now, Wall Street CEOs are issuing warnings. The market looks dangerously concentrated in a few giant tech stocks. And as I mentioned, Michael Burry has huge short positions against the darlings of the AI boom. This looks exactly like the dot-com bubble of 2000. Back then, any company with a .com in its name soared. Today, it's any company that mentions AI. Take Tesla. It's trading at a forward price-to-earnings ratio of 300. That valuation isn't for a car company. It's for a company that might someday build humanoid robots. It's pure speculation. Then you have Nvidia, an incredible company, no doubt. They just announced a new AI data center in Germany. But the stock price assumes decades of flawless, unstoppable growth. Palantir is a similar story. Spectacular company, but even after forecasting higher revenues, the stock is falling because the market is questioning its sky-high valuation. This is a classic sign of a top. When good news can no longer push a stock higher, be careful. The key lesson here is that the market is for exploitation, not for guidance. It doesn't tell you what's right, it gives you opportunities. The rule is simple: buy when there is panic, sell when there is euphoria. If you're finding this analysis useful for navigating this tricky market, take a moment to subscribe to the channel. It's the best way to support this work, and it's completely free. So, if we avoid the euphoric AI stocks, where do we look? We look at what the market is ignoring. We look for value in boring, out-of-favor companies. Some of these are in sectors that have been completely left behind. I'll tell you about a company later that I believe could easily double from here. But first, let's look at an absolute robbery happening in plain sight. The restaurant chain Denny's is being acquired by private equity. The price they're paying is, in my opinion, a steal. It shows you how undervalued some of these traditional, cash-generating businesses are compared to the speculative mania elsewhere. Now, let's talk about some specific ideas. I'm not buying the S&P 500 ETF here. It's too expensive and dominated by the same tech names. Instead, I'm looking at individual companies. Let's start with Comcast. Yes, the cable company. It's trading at its lowest historical multiples, with a forward PE of just 6. It offers a combined shareholder yield from dividends and buybacks of nearly 13%. They plan to spin off their declining TV business, which could unlock even more value. It's incredibly cheap, and if it just returns to a more normal valuation, it could be a huge winner. Next, let's look at the food sector. During the dot-com bust, these defensive stocks did very well. A company like General Mills is trading at a forward PE of 12, well below its average. Sales have been flat, but it's returning over 10% to shareholders through buybacks and dividends. It's a solid, defensive play while you wait for the AI storm to pass. Personally, I prefer Pepsi, but the logic is the same. What about alcohol, another unloved sector? Heineken is a fantastic global company, trading at a cheap PE of 13. It generates cash, pays a dividend, and is actively buying back its own stock. I own it, and I like it a lot at these prices. How about fintech? PayPal is a leader with 400 million users. The stock has been crushed, but sales and profits are still growing. It's very cheap and gives shareholders an annual return of about 9% through massive share buybacks. This is a quality company on sale. I'm also seeing opportunities in areas like cybersecurity with Qualys, which is down 40% from its highs but is cheap and buying back stock. Or in healthcare with Dexcom, a leader in glucose monitoring that is growing fast and finally starting to reward shareholders. On the other hand, I'm avoiding companies that are great businesses but at terrible prices. Royal Caribbean has recovered, but it's expensive and dilutes shareholders. Costco is a phenomenal business, but a forward PE of 45 is just too much. I sold my shares for that very reason. The strategy is clear. Focus on undervalued companies with strong fundamentals, low debt, and a history of treating shareholders well through dividends and buybacks. Be patient. Sometimes the best move is to do nothing and wait for the right price. Remember, you can get more in-depth analysis and ideas in my free newsletter. The link is in the description. Now, I want to hear from you. Do you believe we are in an AI bubble, or is this time really different? Let me know in the comments below.